to exit this trade Friday U.S. session. Why? Friday's the last session of the day. We know the low would probably come in between 9 and 10 or 9 and 11 in the morning. At the session changeover, the reversal comes. So we look for the low of the day London to look for our exit. We get the spike, a repeat of the level, and into consolidation to end the week. If you are a swing trader, that is your exit. Level 1, level 2, level 3. 3 levels of drop, spike the low, end the consolidation, lights out, a couple hundred pips in your pocket. The pattern that I'm going to draw for you and illustrate for you is observed intraday, intra-session, and intra-week. It also plays out on the dailies and the 4-hour chart. But for our purposes here, we're looking for intraday swings and spot trades only. This information will help you in your larger term charts and any other market. That stuff can be traded. Okay. Here's a typical weekly market structure, as I've just discussed it with you, but illustrated again on a different chart. False move week beginning. Spike the low, spike the high, into consolidation. Accumulate and evaluate. Market makers accumulate and evaluate. I hit the high, hit the low, picked up some pennies, what do I got? I spiked high again, what do I got? I spiked low, what do I got? Accumulate and evaluate. Steve, what do they evaluate? How good of a trader I am? No. They're evaluating the contracts and the money. How it's straddled over their spread. That's all it's about. The business is about the money. Now, you have a false move, spike the low. The V3 is vector 3 candles. I'll talk about that in a minute. There's the big fat W formation. Spike the low, pull back, hit it again, jam up the traders, validate the short sellers. Averages are open. This is a down cycle in any other textbook except mine. Straight rise into consolidation, stop hunt low, rise. Next night, stop hunt low, rise. Next night, grab some pendings, stop hunt low, rise. Rise big. 33 trade, another trade we're going to talk about. A 33 trade is a setup. I'll lay the rules out for you. On day 3 of the 3rd level, you have an intraday 3-level rise. That trade will absolutely lead to a reversal. Think about from the market maker perspective for a minute. Every time a retail trader buys, a market maker must in fact sell to him to provide the liquidity. They are not pairing you up, Lou, in New York, with Abo in New Jersey. They're not doing that. They're managing their risk by offsetting that by taking some buys and some sells to manage their risk. But they are not going, oh, let's see, Lou wants to go long. Let me find Pete in Southern California. Looks like he's a seller. Let's match those two guys up and let them hold hands and go against each other. That's not what's going on here. That is a marketing ploy, and it is pure bullshit. Excuse my French. The dealer, the reason you get filled so quickly, the dealer takes the other side of the trade. He has some shorts and some buys. That's just the way it is. The short sellers offset his open long equity. The long holders offset his short equity. It balances. Thanks, Russ. Forgot what language it was. Okay, so now, keep in mind the 3-day cycle. Day 1, Day 2, Day 3. You have 3 levels of intraday rise after the stop hunt. The reversal is imminent. I just was talking about market maker's equity. He's not unlimited. Here's what he does. You're a retail trader. You buy. I sell to you. Day 2. You buy again. I sell to you again. Day 3. You buy. I sell to you again. I look at my books. I'm like, I'm getting a little low on equity. I need to get some back. You're net long as a trader or as a collective group of traders. Market makers are net short. How do you get paid on net short? Correct the market to get your money back. On aggregate, at level 3, market makers go the heaviest. On the retracement, market makers are rewarded and pocket their money. And the cycle repeats. Okay, so now look at the week. False move, week beginning, trap the traders. Evaluate. What do we got? You know what? The averages are showing down. We got some traders trapped long. We're net long right now. Let's make the false move, induce everybody to go short. What is perceived in the marketplace from retail traders as momentum is actually, and has always been, the move by the dealer to trigger the stops. When you see an aggressive move quickly and fast like that, that is a move to trigger the stops. It is done on less volume, and it gets the traders. Look at this from a technical standpoint. Cover that. This is what you have in front of you. You have an aggressive vector 3 or 3 candle aggressive move down, momentum. Breakout traders might have been rewarded on this deal because it's a 100 pip drop. The averages are open and crossed down. That's a technical short. Everybody fell for this. Market makers applied the brakes, lower level short holders snatched it away, went into consolidation in here. That consolidation at the lower level builds short contracts from the amateurs that sell the rises in a downtrend, sell the rallies in a downtrend. That's how the textbook goes. That move, selling the rises in a downtrend, jams up the majority of retail traders short. Now, remember I told you there's a trade designed to get everybody in margin trouble and to keep them jammed. That is called a straightaway, and it comes out of level 1. It is right here on the chart. Okay, see the marking? It's right here. Here's what happens. You sell the rallies in a downtrend, you sell the bounces off the moving average, right? Not understanding the cycle. These are short move continuations for retail traders. Short move continuation for retail traders in here. They have some number of people in margin trouble right there, and some number tracked. Those traders are now stuck. Market makers are counting on you to make an irrational decision. The irrational decision being, lift your stop, scale in the wrong way to a contract, add orders to it, average down, average up, average sideways, whatever the hell you want to call it. They're counting on this. They then, at the beginning of the Asian session, shift the zone away from those traders quickly. See it? 4 straight rise green bar. They then go back into consolidation to accumulate more short selling. They push down, but they don't go past all these levels. They don't go past the levels because it releases the short traders that want to get out with +1, +5, +10 and get their money back that have been down all night. What's anticipated at a level 1 after an aggressive W formation is a straight rise. This is the day that most of the breakout traders will get rewarded. This example, they threw a small stop hunt to the low and stopped out the short pendings. But the long pending side was rewarded. And if you notice, when they come out at London, it's a monster move, straight green candles right out of the box. Why? The aggressive behavior gets everybody into a panic that is net short or in a short position with multiple orders or big contracts or whatever you're trading. That aggressive move, pulling away from the low of the week, pulling away from the low of the week, jams all this volume in here. And jams them up. Some people are asking what DNC is. It's a new term. It's just simply what I say, and I wanted to remind myself of that. Thank you, Whitney. Do not counter trend trade coming out of level 1. Do not counter. Countering coming out of level 1 will jam you up because we expect straight rise because market makers got to get those contracts and hit the triggers of the people that are stuck. Don't counter. That's the place I don't want you to counter. Anywhere else, it's okay. When I say counter trend, I mean counter trend, market maker trend. Okay? Next night, we expect this. Stop hunt low, rise. The next night, we expect this. Stop hunt low, rise. They tricked you out with a little false move, but you got your stop hunt low, pins to the mayonnaise, rise. Notice how when you get to level 3, after the rise, the big candles or the aggressive stop hunt candles turn to the top side, here and here. They are now trapping long holders. Understand? They are trapping traders long now. You guys just hang in there. Just write down mayonnaise. We'll talk about it. As a trader, had a Diet Coke, sip of Diet Coke. You got to understand how to read the moves and understand what's going on in the market. Where the trap volume is, what the market maker is doing, how he's jamming up the traders. That is why it is not necessary to analyze your charts all the way back to Kingdom Come in February of 1907, that people that follow technicals do. Reading the market maker over the last 3 to 5 days at the course of a week will give you a directional bias, identify where the volumes are trapped and where the retail traders are stuck, and you will have your directional. Identify the midweek reversal. Tuesday, Wednesday, or Thursday, it's coming in. Midweek, Sunday, Monday, Tuesday reverse. Wednesday, Thursday drop. Rise Sunday, Monday. Make a big fat M. Drop Tuesday, Wednesday, Thursday, end Friday, and pull back. This is the cycles you have to be able to walk up to a chart and identify. Our group of traders that understands this saw the sell-off coming when they hit the high 3 times on Sunday night going into Monday. When market makers take the trouble to go back a 3rd time to a level and don't break it, the correction is imminent. When market makers go back a 3rd time, repeat the low of the day, the rise is imminent. They didn't go back to the level because they felt sorry for you and wanted to let you out of your trades. They went back there a 3rd time because there was so much freaking money down there they couldn't stand it. They had to come back and grab it. If you understand that and start understanding the other side of the chart, not the side that you see, the side that they are showing to you, and start to think like they think, you will start to have success in the business. And if you get it quickly, a light bulb will go off. It'll be almost immediate. You must anticipate when and how these moves will present themselves. The timings I'm going to talk about, the session starts, session ends, the Brinks trade. I will cover all of this for you. You can truly beat the market maker by simply trading in line with his behaviors. For you new guys, because in the session changeovers, we anticipate a reversal, New York reversal part of the cycle. I want you to start to look to take your profit. If you're a London trader, you need to enter in the London Open and be out by the end of the session. If you're a New York trader, I want you to look to make your entry between 8 and 11. 9:30, we'll talk about that. Look to be out by 12, 1 o'clock in the afternoon. When your take profit is hit, or when the market comes to rest into consolidation to trap the traders for the next day, you take. If a trade does not see substantial profit in 2 hours, take your profit or a small loss. This is not negotiable. Why? If you see a perfect W formation or a setup, and it doesn't move into profit within 2 hours, upon further analysis by the market maker, the contracts were not straddled in the configuration that he had hoped for. This lack of configuration forces him to hold the level beyond the 2 hour mark to accumulate. The accumulation phase on an extended period of time could lead to another stop hunt against the original position you thought you had. Correct. Save yourself the pips. Take a -7 plus 5 plus 2 minus 3. Scratch yourself out and get on with your day. Example. Level 1 consolidation. Okay, we had a three hit to the high in the GBP crosses. They went high one more time at the London Open to validate the long holders, to make them feel good about themselves, warm and fuzzy. The bottom fell out. Today, they showed what appeared to be a W going into the red box. There's no chart up here. I'm talking. Take notes.